Cathie Wood is one of the most popular investors in the stock market right now, especially well known for her aggressive investing style towards very innovative companies. A lot of times, though, that means that she's buying high growth companies that are sometimes unprofitable and highly speculative and thus carry a lot of risk with them. One such stock is, of course, Robinhood, which has been absolutely crashing over the past year. And to be honest, I can't even judge her on that because it's a stock that I've purchased myself too, and I've had to stomach all of that crashing as well. It's a very small position of mine, so thankfully I'll be mostly fine with it, but it's probably the worst performing stock in my entire portfolio, and it's definitely not something that I'm happy about myself. But that's really just a risk that you take with speculative stocks. Sometimes they just perform really bad, and you have to stomach that very poor performance and hope that they recover. But considering how much the stock has crashed at this point, which of course Cathie Wood has used as an opportunity to buy even more of the stock, is right now the perfect time to be buying the stock, especially for me to be able to lower my cost basis and hope to write up a recovery coming off of this? Or is the stock still just too risky even at these lower levels? And should I be thinking about putting my money in safer options instead? That's what we're going to talk about in today's video. Hope you guys enjoy it. Let's get started. What's up, everyone? My name is Ale. Welcome back to my world of stocks. All right, let's go ahead and start by pulling up the stock chart. We'll talk about why the stock has been crashing. I'll talk about why Cathie Wood has continued to buy it despite that, and where I see the company and the stock headed in the future. Let's go ahead and dive in. All right, so no surprise here, Robinhood stock has been an absolute disaster ever since they IPO'd. Well, to be more specific, the stock actually skyrocketed right after the IPO, climbing all the way up to $85 a share, but then it proceeded to plummet all the way down to just the $11 range, which is a monumental crash of 87%. Now, to be clear, the initial pump up to 85 was in large part fueled by Reddit traders and some institutional buying as well, but just in general, this is still a stock that originally IPO'd at around $38 a share, so to crash all the way down here to almost into the single digits, that is still extremely bad. And just to keep it simple, I'll quickly point to 5 specific reasons for this crash. First of all, the stock had climbed way too high from the pump up, so a correction back down was pretty inevitable, and sometimes a much needed correction can fuel a bigger crash if any negative news starts to creep into the stock during the downturn. In Robinhood's case, their price to sales ratio had skyrocketed to over 26. Now today, it's all the way down to less than 5, which is obviously much more reasonable. And the bad news started with reason number 2, which is that their growth started to fall, which can be an absolute nightmare for a highly valued stock that relies so heavily on that growth in order to justify its expensive price tag. As you can see on this chart, total funded accounts was soaring in 2020 and still continued to grow in the first half of 2021, but Q3 and Q4 essentially flatlined without much of any new users at all. And not just that, but the already existing users even started to use the platform a lot less, as monthly active users dropped from 21 million down to 17 million. This resulted in a dramatic drop in quarterly sales, as all the hype and attention that stocks and especially cryptocurrencies were getting from the recovering market coming off of the 2020 recession that was further fueled by stimulus checks and so on, all of that started to die down as the economy kept getting worse with inflation, and now we're going to have rising rates. So people stopped investing as much, and that was especially the case in cryptocurrencies, which is that dark green color on this chart. And you can see how that just absolutely crashed for them in terms of crypto transaction sales, which also leads me to reason number 3, which is that they are too heavily reliant on cryptocurrencies and options trading for their revenues, and that leaves them vulnerable to huge swings in both directions during times of volatility. It's just the nature of the game with a company like Robinhood. They're not going to be a stable, steady growing company. They're going to be a volatile one that will likely see many ups and downs depending on the condition of the broader trading markets and the underlying economy. Speaking of that vulnerability, though, reason number four is because of how reliant they are on trading, which may face significant regulatory pressure in the coming years. And that's something that investors in this stock, in this particular stock, are especially terrified of. See, the way Robinhood makes their money is primarily by sending their large volumes of trades over to market makers who execute the trades for them at a very small difference in price in order to actually make a profit, and then they pay a tiny fraction of that to Robinhood. And sometimes that's not in the best interest of the user, who would rather want, the best buy or sell price for the stock. But instead, they'll kind of manipulate that a little bit so that they can actually make a little bit of a profit. And because of that conflict of interest, Robinhood had to pay an SEC fine of over $60 million back in 2020 related to how they make their money and how much of that information they actually disclose to their users. And by the way, some countries like even the UK have just flat out banned this practice altogether. Now, if the US ever decides to ban this too, which they've already been considering for a while now, then Robinhood would most likely need to remove their commission-free trading and start charging fees to its customers in order to make up the difference, and that could significantly hurt their growth if users start to avoid the platform because of the newly added fees. And finally, I would also add that there is just too much competition in the market. Legacy players like Charles Schwab and E-Trade have started offering commission-free trading themselves to fight off the fast-growing Robinhood, while other newcomers like SoFi have been stealing some of the spotlight from them as well. But despite all of these issues, Cathie Wood has still been a believer in the stock and continued to buy even through some of the worst of this crash. As of today, Robinhood stock is currently the 19th largest holding in her flagship ARK Innovation ETF at over 17 million shares that are worth over $200 million. And when you look at the weight of it in the ETF, you can see that despite the stock price crashing in that yellow goldish line there, the weight of it as a holding in the portfolio or in the ETF has actually gone up. That's because Cathie did a ton of buying with virtually no selling of the stock. Now, to be clear, it looks like her buying stopped by March, but even the last purchases that she made in February were still for around the same price that the stock is trading for today. And out of the 27 total transactions that she's made on Robinhood stock, only one of them was a sell, while every single other one was a buy. I can't fit all of them in this one screenshot, but you guys get the idea. And those purchases were usually for tens or even hundreds of thousands of shares at a time. And it's likely that she'll be holding on to this position for a long time, considering that Wood has frequently stated that her time horizon for her stock holdings are usually around 5 years at the very least. And as far as why she continues to believe in Robinhood even through all of the negativity, she's commented in the past saying that she sees Robinhood as a very disruptive force in the market for its ability to attract especially younger generations, especially those in their 20s and 30s that typically never showed much interest in investing in equities until Robinhood came along and kind of changed all of that by offering a simple mobile platform without any expense, barrier to entry really at all, especially after adding fractional shares and other features, especially cryptocurrencies. All those kinds of things really attracted a lot of younger investors. And I would really have to agree with her. The average age of a Robinhood user is 31 years old, and about half of them are first time investors. So they probably started buying stocks or crypto because of how popular and easy to use Robinhood is. Contrast that with something like Charles Schwab, whose average age is above 50. Now, granted, those older investors have way more money to spend. It's like not even close. But as the younger generations grow older, they'll likely continue to use Robinhood, while more younger generations stack up on top of that, and it ends up kind of snowballing into a lot of users over and over, just piling onto the platform over time, while legacy players like Charles Schwab and E-Trade and so on, they will likely see very little growth in the future, if not maybe even an actual decline in their user base. So Cathie really liked that. And then when also looking at the controversies of how they make their money, what is known as payment for order flow. Well, she stated that she's not really worried about those issues because Robinhood actually does, at least in her opinion, she feels that Robinhood does a good job of giving more value to their customers than if they were to not use those services and have to pay fees. And even if the US banned it, she still feels that Robinhood is disruptive enough to perform well even without the use of the payment for order flow revenue stream. Speaking of which, Robinhood has been investing heavily in new features to help them diversify themselves away from that and become a much more well-rounded fintech company. Their cash card and overall cash management system allows users to make payments both in-store and digitally while also earning interest, and it also gives you the ability to automatically invest your money when you receive direct deposits or whenever you make any purchases, and it also receives rewards and special discounts on certain transactions. They have their new crypto wallet that allows users to transfer cryptocurrencies into and out of their Robinhood crypto account. So if you have supported coins elsewhere, you can consolidate all of them into your Robinhood wallet and then trade them commission free however you want. They're even working on a new lending feature that will allow users to lend out their stocks for interest, which will not only make more money for Robinhood as they, obviously get a cut of that, but it will also make money for the owners, which may encourage more users to come to the platform and maybe even stay on it longer as well. And speaking of people using the platform, they're also aiming to one day offer 24/7 trading, which would be pretty crazy if you're able to like buy and sell stocks at like midnight or even on weekends. I know I would definitely love that myself, and that extra action and engagement will likely result in higher sales for Robinhood too. And then finally, I'll just mention that they're also working to add retirement accounts like IRAs to the platform, which should also help them to hold on to users longer since those are much longer term type of investments. Speaking of the long term, though, that's where I really think that Robinhood has the best chance to shine. I think over time, these additions to their business will help stabilize their growth. But until that happens, I just think Robinhood will continue to be volatile and resemble much more of a cyclical stock. Right now, times are rough. We have a really bad economy with inflation, rising rates. Many growth stocks and cryptos have been getting hit hard as a result. So users are just not that excited as they used to be buying stocks and cryptos at the moment. And that's leading to Robinhood's sales growth actually dropping by about 2% this year, meaning a decline in sales by about 2% this year before they're expected to recover by about 40% next year. But that's still nothing compared to the 1 or 200% bumps that they had in 2020 and 2021. I like the stock at today's levels, trading at around 4 times sales. I think that's pretty darn cheap for a business that has proven that they can have explosive growth in certain years. And I do think that that can be replicated in the future as well in certain years. I don't think that's going to be this year, obviously. It's probably not going to be next year either. But I do think that they have an opportunity to kind of round the corner, get past the very difficult to compare to 2020 and 2021 years, start to build up some smaller growth and kind of set themselves up for some more explosive growth years in the future, especially as they start to diversify their business and add those key elements that they've been missing. Like I said before, right now, Robinhood is a cyclical business. So you don't know when those high explosive growth years are going to come. You don't know when there's going to be a lot of hype that floods into the market for stocks, for cryptocurrencies, and for other things that will provide Robinhood with that explosive growth that could send the stock skyrocketing again at certain times. Right now, it's much more of a cyclical stock. It's going to be volatile, and I think that this is one of those times that you typically see with a cyclical stock where it's just going to be trending downward. And we all know that with cyclical stocks, you want to buy them when they're going down, when the business is struggling, because eventually they will recover and then you want to ride up that recovery. So right now would be the ideal time to be buying a stock like Robinhood that I do believe it has essentially become cyclical. However, the issue is, well, number one, even with any kind of cyclical stock, it's always difficult to do that because it's always hard to buy a stock when it's going down and stomach those losses. Seeing your value in the stock continuously plummet and just hoping that things get better, that's always a difficult thing to do. It's not easy to buy into a stock that feels like a falling knife. But the other issue is that Robinhood is still a very high risk speculative stock. It's not like this is a proven, reliable, profitable company that is cyclical in nature and you could buy into and think, well, it's a very proven company, it's well established, we've seen a history of their cyclicality, so we can buy into the weakness now and we know that it's going to recover and they've got all the profits to make it through any downturns and stuff like that. That's not really the case with Robinhood. It's in much more of an unprofitable company and it's high risk. It's got a lot of competition. So there's a lot of issues here. Growth is obviously a concern, and their business is a concern because they may be too heavily reliant on certain aspects of it. And like I said, there's a lot of competition out there too. It's just kind of making everything more difficult. So it's a tough one. I will probably continue to be buying this stock in pieces in very small amounts. You'll see me say it once in a while, especially in my, monthly update videos. So make sure you're subscribed for those monthly update videos where I tell you guys what stocks I'm buying or selling every month. Every once in a while, you may see me mention Robinhood that I bought a few more shares. But for the most part, I actually don't really consider myself as a buyer right now of Robinhood stock because I have too many speculative stocks. I'm actually trying to move away from them a bit this year and focus more on more safer, reliable companies, especially those that pay dividends. So my heavier buying is going to go towards those companies, and it's definitely not going towards companies like Robinhood. So I'm not going to be doing much buying of Robinhood, but once in a while I may buy a few more shares just to lower my cost basis and have a better opportunity to ride up a recovery if and when that actually does happen. But long term, I do believe in them. I just still think it's very speculative and it is something that I could be wrong on. So I have to keep that within reason and limit my position in it. It's probably always going to be like maybe a 2% of my portfolio type of stock, 2 to 3%. And right now I think it's like at 1%. So anyway, I can still do some more buying, but it's a very small position of mine and that's generally how I feel about it. I just want to be a little more cautious with this type of stock. So anyway, those are my thoughts. I hope you guys enjoyed the video. Let me know what your thoughts are. Let me know what you're going to be doing with this one. Are you still picking up a few more shares here and there, or do you not like it at all? Is it too risky? And do you just prefer to invest in safer companies? Like I said, I'm looking for safer ones right now myself, and I'm looking for more dividends and stuff like that, especially with the way the economy is right now and how shaky the market is. I just think I'll have a better time with some of those other stocks. But anyway, let me know what you guys think down below, and I'll try to respond to as many comments as I can. Thanks again for stopping by. I will catch you guys in the next video. Hope you're all doing well. Take care. Bye-bye.